How can you earn your PhD in retirement? Well, this question may sound a bit odd, but we are going to explain what that means in our financial freedom video, so stay locked in. Hi, my name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. Welcome back to our channel. Well, Carson, understanding the retirement planning process can be so very confusing to most people because there's just so many rules and regulations to keep up with. But today, you're going to be providing insight on the basics that people need.
Yeah, Andrea, my goal today is to help you get your PhD in retirement. But before we talk about all of that, there are 2 rules to retirement income planning that we like to give you. And Andrea, what are those 2 rules?
Well, rule number 1 is to never run out of money. And rule number 2 is to never forget rule number 1.
So let's go ahead and transition to our teaching slides once again in this series and discuss the final areas that you need to focus on in order to earn your PhD in retirement. The third item on this list that you need to understand when it comes to retirement planning 101 are individual retirement accounts, better known, of course, as IRAs. Now, IRAs are personal retirement savings accounts with certain tax benefits. Let's first talk about a traditional IRA. Traditional IRAs have contributions made on a pre-tax basis, much like your 401k plan, and those contributions may also be tax deductible. Now, there are some rules and limitations to how you can deduct money when it's contributed to an IRA, but we're not talking about that on this video, but we have done several videos around those rules and limitations as well that you can definitely go and take a look at so you can fully understand how you can deduct any contributions that you make into an IRA. But it's also to be noted that when those dollars come out, those dollars are also going to be taxable at your ordinary income tax bracket, much like income coming out of a 401k. Also similar to a 401k, when you reach your required minimum distribution age, you will be required to take money from that IRA at the age of 73 or age 75, depending on when you were born. Now, the difference with the required minimum distributions when it comes to IRAs versus 401ks is that even if you're still working, you're going to have to take those distributions from that IRA. Now, if you're still working for the company that you have your 401k with, understand those required minimum distributions won't be due until you stop working for that company. Now, the next IRA that we need to understand under this category are Roth IRAs. Now, contributions to Roth IRAs are the inverse of traditional IRAs because you're making these contributions with after-tax dollars. Of course, the beauty of a Roth IRA is that because you've made these contributions with after-tax dollars, all of the dollars coming out of these funds are going to be tax-free if you've held the account for 5 years or longer, if certain conditions are met. And of course, if you want to know what those conditions are, just like with the traditional IRA, we've done many videos around Roth IRAs so you can fully understand how you can benefit from these types of accounts. The other aspect of a Roth IRA that you should also appreciate is that because you've already paid the taxes on these dollars and you've gotten Uncle Sam off your back, you're no longer required to take money out of these accounts. So you can have money sitting aside your Roth IRA for the entirety of your retirement and not ever be mandated to take any money out of those accounts. And so therefore you can leave it to your estate and it can become a great estate planning tool as well. So this is really important for you to understand if you're trying to, as we say, get your PhD in retirement planning. Another major aspect of your retirement that you need to understand if you're fortunate enough to receive one are your pensions. Now, when we're talking about pensions, these are employer-sponsored retirement plans that provide a fixed income based off of your salary and years of service. Unlike your 401k plan, which is basically known as a defined contribution plan because you're contributing to it, pensions are labeled as defined benefit plans. These are plans that are really funded by your employer. And as I mentioned, a pension is going to provide guaranteed income payments for your life based on a formula involving your salary and your years of service. Another aspect of pensions that you should understand is the vesting schedule before you can qualify for that pension. This is going to be based around a certain number of years that you must be at that company before you are eligible to take that pension. For example, let's say that your company has a vesting schedule of 5 years before you can become eligible for that pension. If you leave that employer in 4 years, you lose the benefit of that pension. So you have to know your vesting schedule so you don't make that mistake. Tough it out for maybe one more year, and you'll still be eligible for the pension that that company is offering. The other thing that you must understand about your pension are the payout options, especially if you will have a spouse who could be depending on that pension upon your death. You need to know if that spouse will be entitled to 100% of that pension, 50% of that pension, or none of that pension. These are things that you definitely should get understood before you sign on the dotted line of receiving your pension. And the last area that you need to understand in order to really have a PhD in retirement planning is your Medicare options. Now, Medicare is simply a federal health insurance program for people turning the age of 65. Now, when it comes to you being eligible for Medicare and applying for those benefits, you have a window to apply for those benefits 3 months before or 3 months after you turn the age of 65. You can also be eligible for Medicare benefits if you've actually been on disability for longer than 24 months. Now, when you're looking at Medicare, you need to know what your coverage is going to include. You need to know that the free portion of Medicare, Medicare Part A, is going to cover your hospital insurance. Your Medicare Part B is going to cover your medical insurance, and you will have a monthly premium that you will pay for that. That's usually deducted from your Social Security benefits. The next part of Medicare that you need to understand is Medicare Part C, which is going to be your Medicare Advantage plans. And the last part of Medicare that you should understand is Medicare Part D, which is going to include your prescription drug coverage. Now, to make sure that you get a full understanding of your healthcare options, I would highly encourage you to reach out to a Medicare specialist in your area so they can sit down with you and scope out what type of plan you're going to need.
After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today.